Hello and welcome to the latest edition of Platts Commodity Pulse. My name is Peter Norfolk. I'm the Editorial Director for Global Shipping and Freight here at Platts. Today we're focusing on the dry bulk freight market, in particular the Atlantic Panamax market. These ships typically carry cargoes of between 70 and 75,000 tonnes and generally referred to as the workhorse of the dry bulk freight market. The last few years have seen very depressed freight rates. It's been a very depressing time for ship owners. Apart from a short-lived spike in rates towards the end of 2013, the environment has been one of very low freight prices. In particular 2015, so far this year, has been almost flatlining in terms of the amount of money owners are getting for transporting cargoes. And we're here today to look at some of the factors behind that. I'm delighted to have with me here today Alex Yunovich. He's the managing editor for EMEA Freight Markets here at Platts. And Alex, turning to from a ship owner perspective, can you kind of explain how this low freight rate environment is impacting on them?
Sure. Well, as you can guess, it's not exactly a picnic for ship owners these days. And the important thing to remember is that it takes a lot of money to run a fleet of vessels. And when the freight rates are consistently low, those costs can outweigh the profits that ship owners make by quite a substantial amount. And just to put numbers in perspective, it takes around $5,000 to $6,000 per day to run a standard Panamax. And this is what's called operating costs. So they include a variety of things like lube oils for the engine, certification, insurance, crewing, and so on and so on. And in order for the vessel to break even, the daily earnings of the vessel have to be higher than these operating costs. Yeah, and a good example here would be quite an important route in the Atlantic, which is Hampton Roads to Rotterdam for the 70,000 metric tons of coal. And as you can see from the graph here, in the last year, the voyage rates have been fluctuating around the $10 per metric ton, except for the dip in the end of the year when it's due to the falling bunker prices, right? And as our sources tell us, at these kind of rates, the time charter equivalent earnings are either just barely covering the operating cost or dip right into the ugly territory of financial losses, right? And of course, there is also the added burden of capital costs or loan repayments that ship owners have to make for the vessels that they procured earlier. And there's no ballpark figure for that, but it can be anything and above $10,000 per day above on the operating costs.
I see, and also as well as ship owners, some of the important players in this market are ship operators who don't necessarily own the ships, but they run a fleet, sometimes quite a sizable fleet of ships. So they do that by hiring in or chartering in ships and then hiring them back out again to another party. So presumably in this kind of market, it's quite difficult for those kind of companies to make a decent margin.
Yes, it is, and actually might be even harder for them and for the head owners. You see, a lot of the vessels that those operators run were hired in the better days when the trees were high and the grass was greener and freight rates were higher as well. So often the higher rates that they pay to their head ship owners is substantially higher than what they can make in the spot market these days.
And you mentioned the costs of running a vessel, and certainly the lion's share of the vessel cost is the fuel. The daily fuel consumption, or the bunker price, is clearly very important in this whole equation. Presumably with the fall in oil prices this year and the lower bunker prices, that's been something of a relief for ship owners.
Well, it's a bit of a groundhog day in shipping a bit, because whenever something like that happens which could help the rates up, usually there's a factor in play that pulls them right back down. And for quite a while now, it has been the imbalance of supply and demand which has been this force. And because there is an acute oversupply of tonnage, ship owners find themselves in a cutthroat competition for every piece of business out there, and that puts them in a very weak negotiating position for the freight, and they have to then pass on the savings they make on the fuel back to the charterers.
I see. So it's not necessarily a straightforward profit situation for them, because they end up having to just pass that cost on.
Exactly, yeah.
Yeah. And if we talk about, we talk about the low freight rates, can you put some kind of numbers on this?
Yeah, of course. The numbers are quite substantial in some cases. The good example would be the Santos Qingdao grain route for 60,000 metric ton cargoes. This is a very important route because we're in the full swing of South American grain season at the minute. As in, you can see actually quite a straight relationship between the bunker prices falling and the freight rates falling here. Yeah, and in numbers, the Santos Qingdao is quite a long route. It takes about 30 days for the vessel delivered in Singapore to get to Santos in ballast, and then about 38 days once it's loaded the cargo to get it to Qingdao. And if we say that a normal Panamax burns around 25 metric tons of fuel per day when in ballast, and around 29 metric tons of fuel when laden, then considering some delays, a party which is running the ship may look at the bill for 1,900 metric tons of fuel by the end of the voyage.
Right.
Yeah, and that's where the price difference really comes in. In 2014 April, the monthly average price for Singapore delivered bunkers were around $591, and this April it was around 341. Yeah, so in April 2013 it would cost for 1,900 metric tons of bunkers around $1.12 million, and this April 646,000. So in rough maths, it's around $500,000 savings for the owners.
Wow.
And they have to pass most of it away.
That's incredible.
Yeah, not just the pocket change.
So presumably for a charterer, someone who needs the ship, who hires the ship, it's a pretty easy time at the moment. I mean, ships are cheap and they don't have to spend much money to ship their cargo from A to B.
Oh, yeah, you know, the beauty of shipping is never that black and white. You know, charterers can be running the ships as well, as we discussed earlier. And, you know, while, yeah, in most cases it's good for them because they can get their way, but if they relet their vessels to the market, for example, if it's a big trader or a producer, then they're facing the same concerns that the normal owners do, like low returns. Also, if the freight rates are consistently low, then some owners might face solvency problems, or the maintenance on their vessels might get worse. Yeah, and as fun as it is to have some cheap ships to run your cargoes, yeah, majority of charterers would prefer to have stable partners with well-maintained fleets, which won't be filing for Chapter 11 anytime soon, and their ships won't be breaking down in the middle of the Atlantic, right? And also, if the freight rates are just flat for a long time in the low levels, it really limits how much money you can make in the paper market, and it also limits your arbitrage opportunities.
I see. So, for example, if you're an end user of cargo, for example, say if you're a power station that's importing coal, you clearly want that reliable partner to make sure that essential coal shipment gets to your power station on time. Therefore, you know, you don't have to do anything drastic like shut operations or something like that. I mean, turning to coal specifically, I mean, that's really one of the two key demand pillars for the Atlantic dry market, isn't it? I mean, what's been happening, particularly the US steam coal, that traditionally has been a big support for cargo volumes for this type of ship. And what's been happening with the US coal export markets?
Well, nothing really good. Yeah, you see, the US steam coal exports have been going down recently, and there is a number of reasons behind it. One of them is that generally the demand in Europe is down. Yeah, the winters were mild in both 2014 and 2015, which kept the port and utility stocks quite high. And also there is a push in the European Union to increase the share of renewable sources in its energy portfolio. So the demand is down, while the costs of producing US coal are quite high due to labor cost, infrastructural constraints, and so on. Yeah, and you can clearly see it from the chart as well. The FOB US East Coast price is sometimes above the CIF delivery price in ARA. So if you add the freight price on top of that, it becomes quite uncompetitive comparing to other suppliers like Colombia, for example, or Russia. Yeah, so the Europe is shifting its suppliers, or share of its suppliers around the world, and it's not necessarily good for the Panamax freight market. Say Colombia, for example, it mostly uses Cape-sized vessels to deliver its coal to Europe.
They're the bigger ships, they're carrying 150,000, 160,000 tons of coal at a time.
Exactly right, so they can benefit from the economy of scale, and they can use them because Colombian ports are not as draft restricted, so they're deeper ports, and also they're not tied in with specific delivery contracts like US is often. Yeah, and since Cape sizes are taking most part of this business, there's very little left for Panamaxes, yeah? And the fact that Cape size rates are also low doesn't help. And Russia has been stepping up as a supplier. That's because the ruble was falling in recent times, and the exporters benefit from that because you know, the buyers, they need to spend less dollars and euros to secure the supplies. And while most of the deliveries from the Baltic Russia are made via Panamaxes, it's quite a short haul run, so the ton-mile demand is not really good, and much worse than it would be from the US.
So if a vessel is making a shorter journey time to deliver the same volume of cargo, clearly that vessel will then appear in the spot market quicker, so it loosens things up and keeps a depressed freight rate because there's more available ships.
That's exactly right.
Just turning to the other main demand factor behind Atlantic Panamax trade, the grain trade, traditionally, in recent years at least, the growing appetite for grain imports into the east has been a key driver, and that's a long route, isn't it? But can you explain what's been happening there with the latest situation with those export markets?
Yeah, well, it's a curious situation there. You see, one of the main drivers for South American grain seasons, for example, is the demand for soybeans in China, which has a massive and hungry crushing industry, because they crush the soybeans to produce soybean meals for poultry and pigs and to produce cooking oil as well. And the demand for it has been nothing but growing in recent years, and so has been the exports from its main suppliers like US or Brazil. And one could think that then the freight rates could be higher as well, just because there is so much business there to make. But unfortunately, there's just too many ships, and that's the problem. And you see, when the grain seasons happen, that's pretty much the best piece of business you can get. And so all the poor earning ships from the Atlantic or the Pacific, they all get pulled in one place. And even though there is a lot of business to have there, the hungry crowd is just too large to feed.
And certainly, in terms of there being too many ships, I mean, that's the other massive factor behind all of this, of course, is the fleet supply. In the boom years of freight in most of the previous decade, that prompted owners who had very high returns to invest in lots of new ships. A lot of those have been delivered now, some still to be delivered. Can we have a look at the fleet profile of the Panamax fleet, and maybe that can offer us some clues as to the future for this sector?
Sure. As you mentioned, it hasn't been really good in terms of for freight rates in the recent years, just because there has been a lot of tonnage coming into the market. But the majority of analysts would say, and our sources as well, say that after 2018 we could see some recovery here, just because you can see it clearly from the chart, the order book is so much smaller than it is at the minute. There is a dark flip side to that though. For this year and the next, the outlook is the bleakest, because you still expect a massive amount of deliveries coming into the already over-tonnage market, Just by the end of this year, 450 new vessels in the Ultramax Mini Cape family is expected to be delivered, which is around 30 million deadweight of capacity, and it's going to be around double that by the end of 2018. That's a lot of tonnage to skim through. The positive side is that the orders went down as well, just because owners see how bad their earnings are. And if you compare quarter 1 2014 to quarter 1 2015, the amount of orders went down by roughly 85%, which is quite a good amount to consider. If it stays that way, then we actually might see the recovery once we pass 2018.
And so just on the flip side, in terms of the age profile of the fleet, compared to the new ships coming in, there are obviously old ships going out. Traditionally, older ships, maybe 20 plus years, 25 plus years, would get scrapped or recycled, so they'd leave the fleet. The age profile for the Panamax fleet, there's quite a lot of potential scrapping candidates there today, right?
Yeah, if you see in the chart, you can see that around 30% of the current Ultramax Panamax fleet is within the 16-year-old or older category, and those are the prime candidates for scrapping. Yes, the majority of owners would prefer to scrap ships after they're 20 years old, just because by this time all the loan repayments are probably made and they can just make money on the ship. But since there's a growing trend in the industry to use eco-efficient vessels, this process can be speeded, and the younger vessels might get scrapped. The eco-efficient vessels can save quite a lot of money on the bunkers per every voyage. Like if we take the Santos Qingdao example that we used earlier, an eco-efficient vessel, modern, built in 2015, for example, can save more than $100,000 per voyage than the vessel built 5 years ago, and that's in current low bunker prices. If those were to rebound, the savings would be higher. So charterers prefer those vessels, and when fixed on voyage, owners prefer those vessels as well. So that's what might prompt them to scrap slightly younger vessels as well. And of course, there is a bit of a inter-family competition. Panamaxes is another part of the Panamax fleet, and they have quite a young fleet, very low proportion of 16-year-old ships or older, and they are often preferred by grain traders as well. So this competition between ships in the same family might prompt all the ships to in the Panamax size scrapped as well.
Okay, so just to wrap up then, I mean, just generally the global economy clearly is key to all this as well. It's been improving a bit recently and prospects seem to be a bit more positive. I guess some crumbs of comfort there for ship owners that things might pick up generally for this market.
Oh yeah, the global economic trade has been growing, so has been output, and of course if the economies pick up, then the seaborne trade is going to benefit as well, and we might see some geopolitical processes that would benefit the ton-mile demand, like if Russian economy recovers and the ruble goes up, then the coal might become less competitive and Europe will switch to more long-haul supplies, which benefits ton-mile demand. Or if international efforts to stabilize Ukraine are successful, then we'll see more grain and coal coming out of there, which will also help. So if we want to be poetic, it might be the darkest hour for Panamaxes right now, but we might see the dawn right around the corner.
Okay, well, in that darkest hour, thank you very much for shedding some light on the situation.
Always holding the torch, yeah.
And so that concludes today's Commodities Pulse. Thank you for joining us, and join us again next time.